All right, what's up, everybody? Welcome to the weekly Trust Engine Productivity Mastermind. So every week, 9 o'clock Friday, Todd Bookspan and I have been doing this, and now Deborah Bird. I mean, I got to quit saying Todd and I. It's the Todd, Deb, and Dave show. Because what has it been, like over 3 years? Has it been 4? How many years have
Yeah,
you
I
been
want to
part of
say
this team?
it was like right when the pandemic hit. So 2020, 2021. Like you would have me on every once in a while, I think in 2020, and then it became more regular in 2021.
Yeah, so Todd is, Deb and I aren't sure what Todd's doing today, but we know he's very thoughtful, he's very strategic, and he's probably doing some type of super dad event right now, if I know my man Todd Bookspan. So Deborah and I are going to go solo. Our special guest, Lance, we're actually, he had some things come up, so we're not sure if he's going to come flying in. He's a pretty interesting dude. Like, if you check out Lance Lambert, co-founder of ResiClub, he's got a real backstory as a data reporter. And then ResiClub is something that I've followed for, I don't know, it might be years. It's definitely been over a year. And I do believe I signed up to be a paid subscriber this year. And I invited him to communicate, just because I think the future of lending and top real estate professionals are data-driven real estate advisors, data-driven mortgage advisors. And I thought he'd be a cool guy to get to know better. Deborah, what's your backstory? Because I know when I told you that we were going to have him, you were really excited about it.
So there's a few people that I follow mainly on different channels. So he's someone that I found on Twitter or X. I highly recommend you guys follow him there. And it's just his data that he puts out. It helps you understand what's really going on in the market, because it can be, kind of confusing when you see data. You don't know where, some of the data points come from and how other factors could be influencing those data points that may not be as similar as where we're at today with the market. I follow him mainly on Twitter. I probably look at his stuff every single day, if not every week, because a lot of the content we create is obviously data-driven, since we work with a lot of the mortgage coaches, mortgage advisors out there on social, not a lot of the transactional type loan officers. So our content typically attracts those who want to, give better advice for the families that they serve.
Yeah, and I just put his LinkedIn for anyone's like, who you guys talking about? His LinkedIn, and then to D Bird's point, X, he's got quite a following. I mean, I want to say he's got like 80,000-ish followers, and he's just always doing a good job of, it's not necessarily sharing data that you can't get other places, but he's putting a story around it. He's why is he sharing it? It's clean, it's on market. Just what he does for free on Twitter and social media is worth money. So highly recommend you follow it as a data advisor. And it looks like we've got Lance coming in. What's up, Lance?
Yeah, thanks for having me. Appreciate it.
Good. We were just setting the table. We didn't know exactly what time you were coming, but the show is live. We usually have a 50 to 100 people live, and then the bigger audience is YouTube. We're glad you're here. I was telling the audience why we were excited to have you. Deborah and I, in the community that we lead, believes that the future mortgage professional, the future real estate professional, needs to be a data-driven advisor. So, we've got a real theme in our community that realtors need to become real estate advisors, and loan officers need to become data-driven mortgage advisors. What are your thoughts on that idea?
Yeah, that makes sense. And before we jump in, do you know what the title will be on YouTube? The title I have here on the calendar invite is How to Help Realtors Sell More Homes Through Data with Lance Lambert. I just wanted, because I try to approach it as a journalist. So I just want to be careful in terms of like saying, hey, read my data, read my stuff, and I'll be able to help you sell more homes. Because that's not necessarily my goal. I'm just trying to report on the housing market and all of that. Although I do believe that for loan officers, for builders, for investors, for real estate agents, everybody in the sector, knowing what's going on in the housing market and being able to, communicate that to other people, to be able to see what their concerns are in the housing market and to help guide them, that is definitely, valuable for everybody in the sector. And so I cover the sector, and I'm not necessarily trying to, help one audience over the other, because my stakeholders who follow my work, they could be everybody from homeowners, renters, buyers, sellers, agents, builders, single family landlord, investors, people who deploy institutional capital into the space, loan officers, etc.
So here's what we'll do is we'll actually come up with the headline at the end of the call. And right now, just what came through my head after hearing you frame that and ask that was how to make confident, better and more confident real estate decisions with Lance, because I do think that's what you do. Like, and I'm a real estate investor. I'm own a personal residence. I'm a leader in the mortgage space. I'm a leader in the real estate space. And at the end of the day, I think when you can help people make more confident, data-driven decisions, you're valuable. Like, you become a more valuable person. Does that align with how you look at it?
Yeah, or another just simple way is U.S. housing market is told by Lance Lambert, but that all works.
Boom. We could do that too. So we made a note of that. That's great to have you. So we I don't know how much you know about our community, but MortgageCoach has been around for over 20 years. And my whole thesis is that how most people get into debt is broken. Hey, here's my rate, here's my payment, here's my cash to close. And that a better way of getting into debt is looking at the total cost over time, looking at options like, should I put points? Should I not do points? And it's always been about helping reshape how people get into debt in America in a more strategic way. And so we've been creating content on YouTube for over 15 years. Deborah Bird is one of the leading social media consultants in the mortgage space. So she's got some of the most successful lenders. She actually has been following you on X for a long time. I'm a subscriber to your premium solution, but just so you know, we're talking to mostly mortgage professionals, and most of them, some of them are real estate investors, so they're looking at it with that lens. And then most of them just want to be more valuable to consumers. And I put realtors in there because they want to be more valuable to realtors. And so, and when you can be more valuable to the homeowner, you become more valuable to the realtor. Does that track?
Yeah, makes sense.
So let's go into when I was kind of researching you before today's call, I knew you as the co-founder of ResiClub, but I found out, hey, you've been a career data reporter. So why did you found ResiClub? Let's just get into the why behind it.
So I don't know how far we want to go back, but like you said, I've been a data journalist in the financial space for quite a while, had worked at places like Bloomberg, and I decided I was going to leave journalism to become a data scientist. And so I took what I considered a bridge job where I'd go work at Realtor.com, still analyze their data, still tell stories with it. But I would be working with their data scientists, their economists, and it would just be a good chance for me on the side to also, do a lot of data courses, Python, all that stuff. And when I was there, and I was there for 2 years at Realtor.com, 2017, 18, and 19, every day I was going through the listing data and going through their databases and querying it. And I learned so much about housing data. And at some point towards the end, I decided, you know what, I don't want to go that direction in terms of, only going the data scientist route. I decided I was going to pull myself more back into journalism. And I went to Fortune magazine. And while I was there, I wasn't brought in to report on the housing market at all. I was brought in there, just to build a data newsletter for Fortune 1000 executives and CEOs. And while I was there, the pandemic occurred, and I was kind of keeping an eye on housing because things were starting to get kind of crazy. And I really just got sucked into it because I just wasn't a fan of the reporting out there. I thought that one, I hated the stories that like are just written nationally and it's like everywhere is the same, is kind of how the stories acted. Like, here is what's happening in the housing market. And they kind of just take the whole market as a, a monolith and act like what's happening in one spot is happening everywhere. And then the other part that really frustrated me with the reporting is that I didn't think that reporters and outlets were putting an emphasis on how important what was happening in housing was, not just in the housing market, but the economy and inflation at large. One of the reasons that the whole supply chain got gummed up during COVID was not just because of the lockdowns. Another part was that there was so much housing demand and so much demand for the remodeling and housing that there was so much demand for those commodities and those goods and those supplies that's what helped to overwhelm the supply chain. And on the other end, the run up, because there was an overheating in housing because housing demand soared up so quickly and there just wasn't a supply response to it. The Fed estimates that housing supply would have needed to increase 300% to match the increase in housing demand during the pandemic. It couldn't happen. So the result there is an overheating where demand just stacks up too much on supply. And I was just fascinated by what was happening in housing. And I just kind of got sucked into it. And at the same time, I was helping to build a business for Fortune called Fortune Education. It was a lead gen business. It's kind of, it makes good money for them now. But doing that and then also doing the housing bit on my own, I kind of got bit by the entrepreneur bug where I was like, wow, I kind of like to build something. I've never actually built something. I've always been just a journalist. And then having built that for them, and then it's like, oh, wow, I built this business for them. It makes good money. I'm not getting a cut of that, right? Yeah, maybe the salary goes up and that stuff. But I just got bit by that entrepreneur bug and I was having success covering housing. People seemed interested in my coverage. I really enjoyed it. I think people can tell I'm very passionate about my coverage. And so that's what ResiClub is. It gives me that bit where I can, kind of satisfy that entrepreneur side of me. And then I can also just really dive in deeper into housing and go deeper than, most reporters or journalists would, right? A lot of them, maybe they briefly cover housing or, they cover the reports like Kay Schiller or whatnot. And I just kind of wanted to go beyond that and dig in deeper. And I kind of found an audience, a lot of industry professionals like my work. And then, some of the people who are investors do. And then, even sometimes buyers and sellers like it as well. And so that was a
Yeah.
long-winded story. But my goal is to create essentially, people's data-driven gateway to the housing market.
Love that. Data-driven gateway to the housing market. Well, we're glad you're here. Congratulations on having a really legit, valuable, entrepreneur-owned platform. I mean, that is beautiful. Guys, we love those reactions. So if you hear something you like throughout the call, use the reactions. Also, guys, we have a real world data scientist, data reporter who's incredibly well educated, studies the housing market. So feel free to put questions in chat and we'll integrate those into the conversation. So Deborah, before I ask the next question, and I got lots of them, anything you want to call out there? Anything you want to ask?
Well, is there anything else in particular based off the national media outlets that you didn't like that really kind of fueled the fire for you to build what you have now? Like, I know you had mentioned, because not every market is the same, obviously, but is there anything else that you were like, I just feel like this truth is missing in the data and I want to make sure it's reported accurately that maybe we're not even aware of?
Yeah, so I think it's I hate even reading a lot of these stories because I breathe, eat, and sleep this housing data and covering the housing market. But it does help me to be able to tell stories better because I will see them do things and I'm like, oh, wow, there's actually better data for this that I could visualize. And so one of the things that I've adopted is that if you read my stories, there's tons of maps in them. And I have lots of maps, and I try to have historical perspective at times. And so I think I try to give people more. It takes a lot of time to build these additional charts, collect this additional data. But I hope that you can read my pieces, and if you read enough of them, you can get a good amount of perspective in different directions and to be able to interpret things on your own as well.
Yes,
Yeah,
the
love
visuals
that.
do help. So for those listening and those who use Mortgage Coach, guys, imagine trying to explain even your own topics to your borrowers that you serve or your partners without the charts, the data, the graphics. That's what I love about Mortgage Coach and why we encourage some people to use it on social, is because it really validates and helps tell the story through images so that people can comprehend, because we're not all data scientists like Lance. So I do like that you kind of water it down for us so that even myself can understand. So thank you.
Yeah. And, I'm a co-founder of a nonprofit called First Home IQ, which is dedicated to financial literacy for high school and college age kids. And a lot around homeownership, because we have this thesis that, kind of the front line of the wealth gap in America is owning, who owns versus who rents. Any thoughts on that? Just someone who lives in the data around, the importance of making data-driven decisions and really understanding the data and the next generation achieving homeownership. Anything that comes to mind there?
Yeah, so I think if you zoom out and you look at it from a historical lens, homeowners have done better than renters on an aggregated basis. I think there are niche examples where maybe that's not necessarily true, where, if somebody in some of these very high cost markets, maybe, took that excess difference between the mortgage and the rent and they invested it and got X returns. But for a lot of people, the forced savings of it and the fact that over the long term nominal prices rise. I mean, over the past 40 years, US home prices are up about 450%. And on the coastal markets, it's closer to 800%. And yeah, you could find some pockets like Louisiana, it's closer to like 170, 200% over the past 40 years. But over the long term, over recent history, homeowners have done better. The anomaly there is that period during GFC, but for the bulk of homeowners who had bought prior to it and held long term, most of them still did better. And so, I don't try to like push home ownership really hard. I don't try to make people feel bad if they're not a homeowner or anything like that. But I do think it's important to have looked at, the historic numbers, in my view.
Yeah, no, agreed. And, we're really careful about not rent shaming and just helping people make the right decisions for them. Any particular top data sources on this? I know Realtor.com comes out with stuff, NAR has their data, but do you have some favorite data sources around reporting renting versus owning?
In terms of renting versus owning, not necessarily. One of the problems with some of these rent versus buy calculators is that they are just trying to take, okay, here's what rent is in a market, and then here is what the cost of a mortgage to buy in that market is. And so, of course, right now, there's a substantial gap where these models would say, hey, it's better to rent in almost every market in the country right now because they're just taking rent versus what that mortgage is. But what the models aren't doing is they aren't factoring in potential future appreciation. They aren't factoring in the fact that, and I'm never one of those people who's like, hey, you got to marry the rate or anything like that. But at some point, if rates were to come in and they were to refinance, that math is different than some of these models suggest. And so, when it comes to the home ownership rent stuff, I would just say be cautious because a lot of these models are just really far off. Because to actually do the calculation the right way, and it doesn't, and I'm not saying that, there has you don't know what's going to happen to home prices, right? There's uncertainty, but even to model something with uncertainty, these models that are just the buy versus rent, and it's taking what a home is now that you could get in your market versus the typical rent, it's misleading. And another reason that it's misleading is because they take the median rent in a market and they compare it to the median home. Well, the home stock for apartments is very different than the median home. They're apples and oranges, right? And so, that home usually, might have 500 more square feet. And so on the buy versus rent stuff, just be careful of the calculations. And that's more of, kind of like doing your research and, looking at history.
So I've got a question I want to ask Deborah, then why don't you be ready for the next one? So here's my question. One of the things that people in our community do as mortgage professionals, they're using social media to bring value to consumers. And for mortgage folks, it's either I'm trying to bring value to consumers or I'm trying to bring value to realtors. And so there's a term, news hacking. I'm sure you're familiar with that concept and that idea. I'm sure to some extent you're doing, your own, you have an integrity in the way in which you do it, but hey, there's hot topics and let's tell our data story around that. I would just love to know the process of a data reporter, like how like anything you're willing to share on a process, because I have a feeling it's something that could help us
so when
do a better job.
When you drive down the road, what's your process of driving? You don't have one because it's effortless. You've been doing it so long. And that's how it feels for me. I don't really think about it. I never, ever have to put thought in like what my next story is or what I'm going to tweet or what I'm going to write. It just flows out of me because I've been doing it so long. It's just, and so that one's kind of hard because if you create content and you do it routinely, and you're writing a lot, and whatever you are producing, whether it's video or it's written, if you're doing it a lot, it will get very effortless over time.
I'm going to push you a little bit. So when I first started doing the interviews like this, I had a process, which was, I call it think, feel, and do. And I wanted like what I want people to think, what I want people to feel. So there's an intellectual, there's an emotional, and do, usually there's either I'm coming across as a coach, sometimes I'm selling, and there's a do. So there's, think, feel, do you, what about like when you first started, did you have like a couple steps in your process or things that you intuitively do?
Well, so now I will say where some effort does go in is I try to look at things through different lenses, and I try to think through, okay, have I covered these areas enough that people feel that they're knowledgeable about them, right? Or I'll have a discussion with somebody who reads my work and I'll realize that they don't understand X, Y, and Z, and that I haven't done a good job of explaining X, Y, and Z in a way that somebody could read that information and then just understand it. But having gone through enough of those, I've kind of gotten it to where I have a better way of explaining things that I hope kind of clicks to people, even if it's a lot of numbers. But, I still don't put a lot of thought into that side of it. More of my thought is like, can I get X, Y, and Z person to talk to me? How can I visualize this better? Just spending a ton of time just thinking about the housing market. I don't know. Hopefully that's a little helpful.
I got value from that. I asked Larry King one time, many years ago, I shared a stage with him. And after I I probably had like 5-10 minutes with him, and I asked him like, Larry, what's the best question? And he was like, and I had actually asked in sequence, do you do any research? And he said, no, I just really focus on being present. And I asked him, what's the best question? And he said, the question after the question. And I was like, oh, okay, I dig that. Well, if something comes to mind, I would love to know. And then Deborah, your turn. Any takeaways or questions?
I do have a question. A lot of the data will track like birth rates, household formations, obviously inventory, active inventory. Is there anything that tracks death rates to know, and not to sound like Debbie Downer, but I had read a stat of this possibly wave or tsunami of the aging out of boomers who could be, which is a large demographic, and they could be passing. Is there anything that tracks that? Because that could create inventory that's not a trade, so not someone who's selling to then go buy. That if you were a mortgage professional or real estate agent, and now that you're, in the business owner space, is there anything we should be looking at or could track to maybe nurture and be able to help this segment that you know of?
In terms of the potential selling from like baby boomers and those older than them into the housing market, essentially, you're talking about people who are leaving the stage in their life where they are a homeowner household, and they're either going to a nursing home or they're passing away. There are calculations for that. It is something that is followed. I could pull it up real quick. Give me a second. Freddie Mac just did an estimate on it. Let me see if they have it.
Because other than that, you don't see any kind of inventory. Like, inventory is still a challenge. It's not like 2008 where there could be people who just walk away from their home. And so is there any other signs that there could be inventory created other than builders in some of the spots in the South? But to your eyes, how does this home affordability and home prices get better?
So the chart that I just dropped in, that's essentially the phenomenon that I don't know if it'll work. Does it open for people?
Let's see.
Yeah, probably. And then you could also share your screen, just as an FYI. And I am going to ask you some questions because, like I said, I'm a fan of your platform, and, one, you provide just an incredible amount of free content, and then you have premium content. And I'm going to ask you to give us a little bit of a demo on it. Know that you're talking to mortgage professionals who also talk to a lot of real estate professionals. So, it's an opportunity to create awareness around what you're doing.
Can you see my screen?
Yes.
Yeah, we see it.
Okay, so this is the cumulative, I can't talk today. This is the change in households from baby boomers. And the stacked approach is showing that over the next 11 years, there will be an exit of 9 million baby boomer homeowner households. So it's estimated by Freddie Mac in the next, 12 years, 10, 11, 12 years, there will be 9 fewer baby boomer homeowner households. And so this has already started. And so over the past year, we've had about 300,000 leave. And then over the next year, it's probably going to be about 400,000. And then after that, that next year to be 500,000 leave. And then after that, about 600,000 leave. And then after that, about 600,000, and then it's 700,000, and it picks up a little bit. We're not talking insane numbers, but it is something that is starting to happen slowly. In terms of overall inventory in the market, I would think of it 2 different ways. One, there is the active listings. That is everything for sale at any given moment. So think of that like the car lot, right? If you drive by the car lot and that car lot is slowly getting more cars because cars are getting delivered to it and they're not selling as fast as they're getting delivered, the car lot can build, right? Now, the actual cars getting dropped off there, those are the new listings, or what you would consider churn in the resale market. So what we are seeing right now is that active listings, so the car lot, is getting more cars on it. It's building up because demand is constrained by the mortgage rate shock. But the number of cars coming onto the market or homes, the new deliveries, is very, very low. It's actually the lowest essentially ever this year and last year. And the reason being is that turnover in the resale market is constrained by mortgage rates going from 3% to 7%. Essentially, that is the lock-in effect, right? Where, or like, you know what, I can't afford really to sell this and go buy something else in the market at these rates. And so, but reversely, let's say mortgage rates were to fall, you could see the number of new listings, you know, in the example of the car deliveries hitting the market go up, right? But on the same side, you could see the number of cars at any given moment on the car lot, despite the number of deliveries going higher, go down. And so active inventory and new listings can go different directions. Just as during the pandemic housing boom, the number of homes going for sale never fell. It never fell. The number of homes for sale at any given time, the actives fell dramatically because the demand was just buying up everything, right? The car lot had nothing on it in that example almost. It was just, they were coming on the market and flying off, so they barely registered as inventory. And so that's kind of how I view inventory data, whereas the new listings is more of a proxy for churn in the resale market and a better proxy for existing home sales and transactions, whereas the active listings is more of a pulse of the supply-demand equilibrium and where pricing, the trajectory of pricing power is moving. And right now, the trajectory of pricing power is moving to buyers in some of these markets getting more power because the actives are slowly building, despite the lock-in effect still being very real. And so I know I just threw a lot out there, but that is essentially how I view active inventory and new listings.
So
And so the lock-in effect, just one more thing, the lock-in effect does not have an impact, in my view, on active inventory. It has an impact on churn in the resale market, the turnover in existing home sales, and the new listings.
okay, I'm gonna have to think on that one. That was a formula there. You know, hey, Lance, I would love, if you're cool with it, I would love for you to walk us through, you know, your platform, because you put a lot of intention into what you make available free in the market. If you could kind of share that at a high level, and then show us your premium platform, you know, because I want mortgage and real estate professionals to, you know, for their advice to matter. And I think, you know, for your advice to matter, they need to know the data. They need to be a little bit of a data nerd. So do you mind giving us an overview of both your freemium content and your premium content?
Yeah, happy to do that. Give me a second to close out a.
And remember, guys, we've got a guy who is, you know, just had a career as a data reporter, a passion around real estate data, and he is doing something incredibly unique. I mean, this is, you know, a very unique platform. I mean, my take is most of the content we consume, it's got some agenda around it. You know, it's either got the agenda that it's taking nothing away from NAR, but they just want to sell more homes. And so they're, you know, giving you data in a certain light. Mainstream media is trying to get clicks, and they're giving you data to drive clicks and ad dollars. And Lance has an agenda. He wants you to subscribe to his platform and get value from his data. But that's, to me, that's a pretty good agenda if you want good, pure data. So ask questions and make note. Okay, go ahead, Lance.
So this is something we published this week. ResiClub did a survey of investors. And so we asked them things like, are they concerned about home insurance premiums? And that is a really big concern among the investor crowd right now, because while we've seen an overheating in prices and an overheating or spike in mortgage rates, investors and landlords didn't necessarily feel that, right? They actually gained from, you know, the prices going up. But insurance, that is one that actually hits to the cash flow, unlike the other two. Now, investors do feel it if they go to buy something else, but from their existing portfolios. We asked them how much they think that prices in their market could go up over the next 12 months, how much they think rents could go up in their next 12 months. And we segmented everything by region. We asked how would they describe the housing market? Most of them think underbuilt. Are they concerned about natural disasters? What are their biggest concerns about the housing market over the next 12 months? Higher for longer, that's everybody's concern. What are their concerns 10 years out? Strained housing affordability. And so we not only are, getting a lot of data from sources, we're also out there creating our own research and trying to, find ways to find pulses on the housing market. Let me go through some other stuff. This one is a premium story, and I'm actually not logged into my own site, so I can't actually view it. Give me a second to log in. Well, I'll keep going through it and I'll circle back to those. And we send, a story out usually every day. So here is a look at, we built a scatter plot to help us track where active inventory is shifting. And this bar down here at the bottom, this x-axis, this is the 5-year change in inventory. And over here on the y-axis, this is the 1-year change. And what you will see is that everywhere above 0 right here, inventory is increasing right now on a year-over-year basis. So almost the entire country, inventory is up. But if you look over here in the green, these are the few places, only 32 of the 200 largest markets, that have returned the pre-pandemic inventory level, whereas everybody else is still below. And these yellow dots are just markets in Florida and Texas, and that's where inventory is increasing the fastest. And then if you go down here, these ones in the blue, these are the Midwest and Northeast, and that's where active inventory right now has stayed the tightest. Let's see.
Deborah, go ahead, Lance.
I get forecast from about 9 different groups, and the most bearish forecast right now is Moody's. They essentially see U.S. home prices going sideways for a couple years, and the most bullish is Goldman Sachs, that thinks that we're going to remain about the historical average for the next couple years. And so in the piece, I got the thoughts from Goldman, I got the thoughts from Moody's. That's an example of like a daily hit that I send out to people. That's a free story.
Wow.
I have existing home sales forecast from all the groups. Here's Goldman's. The next couple of years, they think that, it's going to remain fairly constrained. The piece explains why, but they think that new home sales are going to be much more resilient. I know actually the number of all the homes in the country that institutional players have. I actually have the addresses for all of them. This is a story looking at the markets where mom and pops, those who own between 2 and 9 homes, own the most. And then I compared that with where institutional home ownership is the highest. Institutional home ownership is the highest in the Southeast, in particular in Atlanta, where they own about 4.3% of all single family homes. And
it's just so much data, so much value. What is the breakup of your customer if you had a mortgage professional, real estate professional, investor? What do you think your subscriber base is at a high level?
I would say around a third is single family landlord investors. I never targeted that audience, but nobody really writes to them. And so I've gotten a lot of them. There's a huge number of agent brokers who are in there, around a third probably. And then the rest, mortgage, home builders, most of the CEOs of these companies read my stuff. And it's really a mix. I don't try to write for one particular audience. I'm really just kind of obsessed with, finding out what's going on in the housing market.
Obsessed with impact. So give us a little tour of if someone subscribes and becomes a premium member. 1, how they would do it, and 2, what do they get?
Yeah, give me a second.
Corey just subscribed. And by the way, guys, if you're on this and you're watching this, if you came in late, we're talking to the co-founder of ResiClub, Lance Lambert. He's one, answering questions around data, two, giving a tour of free content, where to go and how to get it. And then he's also getting ready to, log into his platform and give us a tour of what you get behind the, and what is the price?
$2.99 for the premium. If you message me afterwards, I could give a discount code if you want to share with your audience.
We'll put a link down below. So we'll get a link. So anyone that's watching this, if you're watching this in our YouTube channel, in show notes down below at the very top, the first link will be a link to sign up and become a pro, ResiClub Pro.
And so here's a piece I sent out last weekend. Zillow did a new estimate on how short they think the housing market is. Last year, they said we had a 4.3 million deficit. Now they say 4.5. So I got their commentary. And then I also reached out to them and was like, hey, can you give us your raw analysis? Because if somebody says that the housing market is short, that could vary by market, right? And so they gave us their raw data. And then I compared that. I took the raw data and then I compared that to population. And what I found is for every 30 people, there is one home short in San Francisco. And then if you go way down into Memphis, for every 399 people, Zillow says they're short one home. And so what this analysis says is that, these coastal markets, there's an acute housing shortage. And then a lot of these other markets, maybe not as much. And then I track all of these housing shortage studies from all the groups. Zillow has had the biggest number. Zonda, Moody's, JP Morgan, they have a little bit smaller, but everybody still thinks that the market to some degree is undersupplied. And so I do a lot of those where I do a lot of roundups. Here's all the home price forecasts for next year already from all the groups. Moody's is the lowest, Goldman Sachs is the highest. Again, those are national numbers though.
Why is there such a wide spread? Like even for the housing shortage, like that's a pretty wide spread between the two or all the groups. Why is that?
Yeah, because some of them will do an analysis like, and that's a great question.
I think that's what's so confusing to the average consumers. When you look at that, you're like, okay, but if it's a housing shortage, shouldn't we be looking at very similar data points to be able to calculate that number? So why, like I can understand with interest rate forecasts, but
here is how you would do a conservative analysis. And this is why, in the groups who have the lower number, they do a more conservative analysis. And what they do is they take the vacancy rate, which right now is very, very low. There are not many vacant homes in the US. And they say, okay, here's how many homes we would have to have on the market that are vacant to get us back to a historical normal for the vacancy rate. And so to get the vacancy rate back to normal, you need about 1.5 million homes. And so that's what Freddie has in this analysis, is that we've slowly, the vacancy rate has dropped, and here's how we would get back to a normal market, which is where we were in 2000 and where we were in 2014. Now, there are other analyses like Zillow that go beyond that, and they say, well, affordability has priced out millions of homeowners. And so they also factor in the decreased household formation because of affordability. And so their argument is that there are several million people who live with their parents that would have otherwise bought a home. And so that's how you go from a conservative analysis to one that starts to get to be a much, much higher number. And so Freddie Mac, that's their conservative number, but they also have another analysis that does what Zillow does and puts it closer to like 3.4 million undersupplied. Let me show, the thing that I like the most that I do are my inventory tracker and my home price tracker. So let me pull those up. So this is my monthly home price analysis that I send out to my pro members. And what I do here is I have an interactive map for county level home prices year over year. And so you could pull it up, you could go into it, and you could see the year over year rate in any US county that you want to using the Zillow data. And you can zoom into it. So there's the year over year chart. Then I have, that's the county one. Now this one is metro, and it's sized by market size of active inventory. So you can kind of see, okay, a lot of the places that are declining are actually really small counties and parts of like rural, Texas or Louisiana. But if you look at it at the metro level, most of the bigger metros are up right now, year over year. The exception being some of these parts of the Gulf. And then I have my tables, and I'm a huge fan of my tables. And I put a lot of thought into building these. And so I have the month over month number. But remember, this is April to May, which seasonally, that's the strongest month of the year. Then I have year to date, how much we're up year to date. I have year over year. I have shift since the peak of 2022, shift from the market's all-time high, and then change since March 2020. And so you could take a market like Austin, they're down 18% from the peak, but they're still up 41% from March 2020. And how does that happen? Well, the market overheated and they were up 68% from March 2020 to June or to May 2022. They just went up too high too quickly, and they've seen a bit of a correction. And then you could also go up here, you could open up my price tracker. And in the tracker are spreadsheets where you could get all of this data that I use to make the analysis. You could find the 20-year change for every market, the 9-year change, the 5-year change, etc. You could get it for county. You can get it for all the metros in the US. If you don't like Zillow data, you're like, you know what, I don't want Zillow data. You could go in here and here's the Freddie Mac data. If you're like, you know what, Lance, I don't want to see the calculations, just give me the raw data. You could go into the raw data and get all the raw data that I use to make all the analysis. And so from these spreadsheets are how I do almost all of my charts that I tweet, most of my charts that I do for the stories. Not everybody likes the spreadsheets, but if you're, somebody who really wants the spreadsheets or you want to make your own charts, it's all there. And so that's my home price one that I do monthly. And then I also have the inventory one. So give me a second, I'll pull that up.
This is awesome.
Yeah.
Like I have your pro edition, but I haven't really used it. Like I wanted to have it all and signed up, and I think I've logged it a few times, but I, primarily still use your kind of surface free content for decision making and, wherever it adds value. But I'm going to dig in this weekend. It looks like we've got a number. Oh, go ahead.
I was going to say, just think of your first home IQ community being able to show the very hyper local county data and home price change from a 20-year, 10-year, that's very powerful for your group there, don't you think?
Yeah, totally. Yeah, no, I'll definitely make sure we share this in First Home IQ community. And again, Lance, this will be in the Mortgage Coach YouTube channel and our Facebook group, and would love to have you as involved as you want to be. But anyways, keep
another
going.
thing is, in the Zillow spreadsheet, in that tab, you get the 20-year, but if you go open the Freddie Mac one, you can get the 40-year. And so national home prices over the past 40 years are up 499%, so 500% over between April 1984 and April 2024.
Wow.
And in parts of Washington and like Bend, Oregon's up 1,000%.
Jeez.
And so let me go open up my inventory tracker. And so here's year over year change. You can see that inventory pretty much across the whole country is rising right now. But then if you look since pre-pandemic levels, while inventory is rising right now, we're still in most of the country well below pre-pandemic inventory levels for active listings. And what you will see is that in the Northeast and Midwest, things are very tight. But if you go back over and you look at the price data that I just showed you, and let me pull that up again. And sorry if I'm taking you guys all over the place.
Hey, we brought you here to mastermind with you, learn from you, and this is useful and helpful.
So give me a second. Okay, so here's the pricing data. Back to where we showed that. Okay, so what you will see is that the Northeast and Midwest are really the leaders in price appreciation right now, and also Southern California. And if you go back and look at the inventory, that's also where inventory is the tightest. And the places where prices are falling are also those places where active listings have come up much quicker. And this inventory one is essentially the same thing as the price one, but just inventory data. So here it's sized by market. And what you will see is it's around the Gulf, these Gulf states where inventory is increased the most. Austin, New Orleans, Tampa, those are also the places where prices are softening a bit. And then it's the same thing, whereas I had my price table, but these are my inventory table cuts. And so the two most important columns here are this 5-year change. And these markets at the top, Austin, San Antonio, Memphis, New Orleans, Tampa, and Phoenix, those are the weakest markets also for pricing. Whereas these ones like Hartford, Connecticut, and Providence, and Chicago, MSA, and Virginia Beach, these are where prices are actually still going a bit stronger in terms of elevated growth. And the actives in those markets are just so tight. I mean, a market like Hartford, if you're down 80% from pre-pandemic inventory levels, that means for every 4 homes that were for sale in Hartford, Connecticut in May 2024, there's only 1 home now. Actually, no, my math's wrong. It was for every 5 homes for sale then, there's only 1 home now. That's how tight that resale market is at the moment. And here's the national ones. And you could go click in here, open up the tables. Most of my charts I usually make interactive. All the ones you just saw above, you could click the link and they'd be interactive. I don't know why this one's loading. So, okay, here it is. So you could go through, you could open up Austin. This is a market that gets talked about a lot, softening. You could go open up Hartford that I was just talking about that is still very tight. I mean, look at that. For every 1 home for sale now, there used to be 5 pre-pandemic. That market is still tight. It's still overheating. And so these data stories pretty much every once in a while I will come across something that maybe I haven't covered or don't have data for. But there's a wealth of data and insights and discussions with CEOs across this industry if you want different perspectives as well.
So guys, data stories and wealth stories. You know, I interviewed Denise Donahue a couple of weeks ago, Deborah's twin sister, one of America's top mortgage professionals and leaders. In that call, we talked a lot about leadership, and she made the case that every week you should be telling wealth stories, you know, stories around how you help families make better decisions that help them achieve growth and wealth, not just a pre-qualification. And every week, guys, you should be telling data stories. Deborah, we're in the last 5 minutes. Anything you want to call out or anything you want to push to everyone from a social media perspective?
Well, I had one more question if I can squeeze it in. And I don't know, Lance, if you have this, but I had made a post for Win by Noon, and the data came from John Burns' demographic analysis where it showed, I think it was 12,000 people turning 35 every day. Do you have anything like that from like how many are turning 18 and can vote, or 21? Like some of the major mile markers. Do you have anything like that for, I'm just thinking for selfishly for future content that we create, I'd love to know those like major milestones. Is that something justifying?
And
So, yeah,
layering in that, do you have anything around those ages and home ownership? Like how many 21, people are buying homes in their 20s versus 34. Like, do you have anything that breaks that
I
down?
haven't done a data story on it since I launched in October, but now that you say it, I know where to get the data and I can visualize it and I'll make a nice story.
Oh,
So when
good.
you see
Good.
it in a few weeks,
Yeah.
you'll know, oh, that's from this.
Yeah. Well,
And
I'll tell you the way we would love that, like it again, not about rent shaming at all, but more and more the narrative. I had one of my son just graduated from college last year, and most of the kids, unless they come from a family with means, they don't know if they can own a home, and they also don't know why they should, they don't with clarity and data. And so I do think showing that shift that's taking place in America, how it's older and older and older, and then giving some inspiration that, hey, there are 21-year-olds and 22-year-olds doing it. I think it would be really insightful and helpful.
And then another thing is with ResiClub, is that I not only cover the single family market is, of course, the thing that I care the most about, pricing, inventory, that stuff, and home building as well. But I also cover, a bit of multifamily office in terms of not to go too deep into the weeds there, but enough that people can understand, what's going on in these other segments. Because a lot of times you will see headlines right now about real estate crash or some really gloomy headlines. And what they're really talking about is office, right? Or the commercial side. And if you look at this chart, this itty bitty dot right here, that's the number of offices currently being started for construction. That market has crashed harder than any real estate market ever. This crash that's going on in office right now is just historic. It's essentially once this bit moves through the pipeline, they're just done building on that side. Now there will be some office to resi conversions and stuff like that. But so the point being there that I try to keep you updated on lots of developments happening across not just housing, but real estate at large.
Well, I think you're going to see an explosion of office conversion. That's what's, how are we going to make you put that space to use? It's going to be converted into something else, because it's not like everybody's just going to all go back to work. COVID changed the game. So why don't you stop sharing real quick? Let's go into wrap up mode. So Deborah, be ready to do the win by noon closeout in a minute, but I do want to give Lance any last things. You've got literally, you may have over 1,000 plus loan officers and realtors. Any closing thoughts that you want to leave any of these housing professionals with?
Yeah, the thing is that I think with the closing is that right now we are in a historic period for housing where we have seen this historic deterioration and that's what happens when prices overheat followed by a rate shock. And so there's a lot of angst, a lot of uncertainty, but understanding what's going on in the market and seeing how the trends unfold, I think is critical and helps to not only, help with your career, but then also, to be able to, relate to other people with it as well. And so I think it's an important time to pay attention to housing. And it's also in a time where there is so much nuance happening in housing, where what is happening in the home building sector, where things have been much more resilient, especially for the publicly traded big dogs, versus what's going on in office is dramatically different. Or what somebody might see in the resale market as a buyer in Hartford, Connecticut, or Providence, Rhode Island, is significantly different than what somebody could see right now in Cape Coral or parts of Southwest Florida. And so I think it's an important time to pay attention to what's going on in the market and kind of being able to see where these trends are moving.
Beautiful. Thank you. So Deborah, win by noon closeout.
So I think it's no surprise that, obviously sales and the number of transactions is down, which means every lead, every conversation matters more than ever. So today happens to be the last official business day for the first half of 2024. I want you to go back and reflect, what are some of the wealth stories and perhaps data stories that are typical for Q1, Q2 that you need to study, review, share on social, share in your email marketing, but then how are you going to pivot and prepare for what's ahead? There's a lot of people that are concerned with it just being an election year, who get scared by seeing some of the media news that is very doom and gloom. And, you know, a lot of times people don't realize the cost of waiting. You know, when in the 80s, when it wasn't as affordable, had people waited to like the 90s when home prices were higher, they could have outpriced themselves to ever be able to afford home ownership. So, you know, as we wrap up the first half of the year, I want to hear the wealth stories, and let's change the scoreboard from just number of families served and volume to impact, and how are we sharing those stories online that is based off truth and not just fear or click tactics.
Cool. So here's my closing thought, guys, and I'm going to give a little sneak peek into my Monday leadership message. It's going to be titled "Get Better, Not Bitter." And it's a tough market out there. There are a lot of people that are getting bitter. The NAR settlement is got a number of realtors either scared or bitter. And you know, the people who are going to win in the NAR settlement, post-NAR settlement era, are people that are getting better and creating more value for consumers, being more transparent with consumers, helping people make data-driven decisions. So to me, one of the cornerstones of getting better is to be smart with data and to follow platforms like this. I'll leave it to you whether you want to invest and be a premium member, but you know, check it out, make this part of your read, and get better. And being data-driven is how you get better. So, hey, man, it was really good to meet you, Lance. You did not disappoint. I didn't know you, but you killed it. And we'll have a link down below for anyone that wants to get the premium sign up. And we'll also put a link with other places to follow Lance online.
And the one last thing I wanted to mention is, you know, if people don't want to get the premium product, the free product, I still do a lot of stories, right? And I give away a lot of good content there as well. Now, people want to get the premium, you get more, but people who just sign up for the free newsletter, you're going to get a lot of good data stuff as well.
By the way, and I can attest to that. I was a free customer for over a year, getting the newsletter, you know, following them on, I think, X, but I think I followed them on other channels. And then you know, going into this year, I'm like, you know what, I need to be as deep as possible, and I just signed up. So anyways, check it out, everyone. Lance, have a great weekend. Really great meeting you, bro.
Thank you.
Bye.
This is a wrap. Take care, everybody.